Hello again everyone, it's Paul Tilley and welcome back to our explanation of the balance sheet and income statement. In this short video what I'm going to show you is a typical balance sheet and a typical income statement, and we'll explain the ins and outs of these statements so you'll have an idea of how to review them yourself. So first of all, I want to take a look at the balance sheet. The balance sheet, first of all, is normally presented in a manner similar to what I'm presenting here. Not all of them look identical in format, but they all have the same setup. Okay? First and foremost, the balance sheet will have information with regards to what it's a balance sheet for. In this case, this is a balance sheet for a company called Northern Machining. Now, Northern Machining, it is a separate entity from its owners. So we consider the entity concept, meaning that what we're doing is measuring the value of this business separate from its owners. Okay? So, and this is a snapshot document because you will notice that Northern Machining is a balance sheet at December 31st. And the reason that we pick a day is this is the end of their accounting cycle. So we do a measurement. The business is ongoing, so we do a measurement at the end of its year. Now, it's an arbitrary day what day we pick as the end of the year, but most businesses have a year end that falls similar to the calendar year. December 31st is a popular date, but other dates exist too, such as March 31st and the like. But one thing you need to look at is what is the date that we're looking at here. In this particular example, it's December 31st. You'll also notice that there's no year on it because what we're reflecting here are two separate years, 2019 and 2018. So we have information from one year and information from the next, and they match up, and it's good for comparative purposes. You'll also notice that this balance sheet has three distinct divisions. Its first division, assets. Now, asset is a fancy word for what the business owns. It is the useful things that a business employs in order to do what it does in its business. Okay, so it's made up of money, accounts receivable, all sorts of different things that are considered as being owned by the business. Now keep in mind it's separate from the owner, so this is what the business has. It's normally presented in a format that takes the most liquid assets. What we mean by liquid is that they can be turned into cash within a relatively short point in time. The most liquid assets to the least liquid assets. So it rolls down through most liquid to least liquid. In this particular case, you'll see a grouping called current assets. Current assets are assets that can be converted to cash within 1 year. And current assets, there are many different types of current assets. You'll see some exampled here. Cash, for example, is very liquid because it is cash already. You don't have to convert it into anything. Marketable securities are just investments that the business has that can be sold very easily. Accounts receivable, which is money owed to the company by its customers. And again, we would expect that those would come in within a year, certainly within a year, hopefully a lot shorter than that, but they are very close to cash. Notes receivable is similar to accounts receivable. Notes receivable tend to be a little bit longer than 30 days or 90 days. It could be like 6 months or a year. And inventory, we often consider inventory to be relatively liquid, meaning that it gets sold within the year. So these are all considered as current assets. So most financial statements will have a breakout section under assets called current assets. And all current assets means is that they're pretty close to cash and something that the business can convert to cash very easily. As we move down, we'll see something called fixed assets. Now fixed assets are assets that are longer lived and are not as easily converted into cash, but very essential to the business. So things like land, buildings, machinery, furniture, fixtures are all considered as fixed assets. They're recorded on the balance sheet as what we call historic value. In other words, we paid that much for them to start with, and that's the figure that's going to be recorded in the balance sheet. Okay, so this land, for example, we paid $5,500 for it. That's what recorded in the balance sheet. Building, we paid $180,000 for it. That's what's recorded in the balance sheet. These fixed assets are all added up then to give us a total fixed assets. In this particular example too, we have something called intangible assets. Intangible assets are untouchable assets. They're non-physical assets that are worth something to the business, such as its reputation or patents, which are protections against various designs and products that the company produce, and goodwill, which is just the positive vibe that you get from a business. Now, goodwill has to be measured in the sense that you have to buy a business that has a value that is higher than its book value. So goodwill is a non-touchable asset, but it has some worth. You can imagine, for example, Tim Hortons brand name has some worth that adds value to the company. In total, you will see in this particular example that for 2019, the total assets was around $468,000. The previous year, you can see it was $492,000. So you get a sense for how much the business owns. So this is very much what the business owns. Now, so this is one side of the balance sheet. The opposite side of the balance sheet is made up of two distinct categories: liabilities and owner's equity. Liabilities are monies that are owed to outsiders. What I mean by outsiders is these are people who don't own the business. These are outsiders of the business that this company owes money to. And we look at liabilities, for example, we can see liabilities could be considered, we have current liabilities, which are again like current assets. They're ones that are coming due within 1 year. So accounts payable, which is money owed to other businesses. Notes payable, which is longer term accounts payable that are owed to other businesses. Accrued expenses, meaning that we're incurring some expenses as we go along, and for the purposes of this statement, which is measured on a day, we haven't really paid for them yet, but in a few days' time or in a short order, we're going to have to pay for them, so they're called accrued expenses. Taxes payable to the federal government, provincial government, for example, and the current portion of long-term debt. So all we're saying is that's what we're going to have to pay this year. So those are what are considered as current liabilities. We also have longer-term liabilities, which are liabilities that extend past 1 year. These would include loans and other long-term liabilities. Now, one thing that I want you to notice is that these total liabilities can be totaled up and it will come to an amount. So you need to be able to total up your total liabilities. We also lump in what's owed to owners. And this is money that the business owes to its owners. And this is usually recorded separate, again, such as owner's equity, which is what the owners invested in the business to start with. We add our net income from the previous year, and I'll explain that in a little bit. Subtract owner withdrawals and any what's called retained earnings. The business has earned money and stayed in the business. If we take the total of the liabilities that are owed and the total of the owner's equity, it will total up to an amount that is identical to the asset. In other words, assets will equal liabilities and owner's equity. So what the business owes always balances what the business owns. And again, I have comparative data for the year. So this is what is considered a balance sheet. So it's a snapshot of a point in time with the business that really says this is how much we owe and this is how much we own. The next statement that I wanted to show you was something called the income statement. Now the income statement, unlike the balance sheet, the income statement is a flow statement. It measures the revenue and the expenses incurred by a business over the course of its 1 year of economic operation. This date is shown on this one as well, and the end date will correspond to the balance sheet. You'll notice, for example, no other machining income statement for year ending December 31st. Well, our balance sheet is at December 31st, and so is our income statement. But the income statement covers a period from January 1st through to December 31st. This is why it says for the period, the year ending or the period ending. It covers a year. So it's a flow statement. And in this flow, we're recording our revenues and our expenses to get our profit. So let's look at some of the potential revenues of a business. Well, in this particular, it's simple. It's just one simple revenue, sales revenue. There could be other sources of income for other businesses, and if you look at other income statements, you will see many other different types of income. But the fact is that you have to recognize that it's a flow into the business. It's some form of revenue, money coming in the business from outside that didn't exist before. We also keep track of our expenses for the year, and our expenses are laid out here. And, different businesses would have different types of expenses, but generally expenses can be broken into what's called operating expenses, which are directly related to the operations, and we have other operating expenses or general expenses, which are kind of not so directly related to the operation, but certainly are incurred. So, for example, salary expense, commission expense, advertising expense, sales supplies, delivery expenses, salespeople insurance, salespeople communications are all directly related to the selling effort, hence they're operating expenses for selling. However, management salaries, office support, accounting services, counseling service, consulting services, legal services, and something called the depreciation expense are all, you can't really say that's directly relatable to a given selling a given product. So these are what are called general administrative expenses. We take our revenue, we subtract our expenses, and this will give us our profit for the year. So that's how the income statement works. Now, I just want to talk about a couple of things here. First of all, this depreciation expense. If you recall, what I said back here when we looked at the balance sheet is that assets are recorded at what's called historic cost, meaning that if we paid, let's take this building for example. When we bought the building, we paid $180,000 for it. Now that building has what's called a useful life. It will only last so long, and we really need to be able to find a way to lower that value, because as the building gets older, let's assume the building is 50 years old, is it worth $180,000? And we're talking about the physical structure now as opposed to anything else. Well, the physical structure, it might be worth more, but generally we have to be able to say to it, it's going to wear out and it's going to be less valuable. So what we do with assets is we record an historic cost, but we expense them as their useful life disappears. So a building, for example, we might say will last 20 years. So what we'll do is we'll take 1/20th of that amount that we spent on it and charge off every single year as what's called depreciation expense. And this is where you see this number right here. It just represents the decline in value of the assets as we use them up. The other thing I wanted to reference was the fact that our net income, how does it relate? Well, we take our net income for a given year, so in this case it's 2019. That net income is going to be reflected in the balance sheet for 2018 as coming in and adding to owner's equity. So you'll see that the net income, $8,300, gets put into owner's equity. Once you have some experience with these things, they start to make some sense. But the thrust of it is, from our perspective here for this course, is you have to recognize what a balance sheet is. It's a point in time that says, yeah, our business has this much owning and it owes this much. An income statement is a measure of how much is generated during the calendar year or during the fiscal year of a business. A calendar year ends December 31st. A fiscal year could end, it's a year point in time, but it could start somewhere during the calendar year and end somewhere during. So it really needs to do a measure. So this is like the taps in a bathtub and the water flowing into the bathtub, whereas the balance sheet is like the bathtub itself. It measures how much water is in the tub at any given point in time. So that's a brief explanation there. I hope that that has been useful to you. Thanks for watching.